Welcome to InvestStream, everyone. This is Pankaj, and today we got two very special guests. We've got Shruti from Array VC and Paul from 2048 VC here in New York City. We're going to be talking about early stage investing. So, welcome, Paul and Shruti.
Hi.
Thank you very much for joining us today. How are you all doing? Good?
Yeah, we're pretty good.
Great.
Shruti, if you'd like to start, give us a quick background on yourself and Array and kind of what stage you're investing in, check sizes, types of companies that you're looking at. That'd be great to start.
Yeah, first of all, thanks for having me. And my name is Shruti Gandhi. I run a fund called Array Ventures. We at Array invest in enterprise early stage companies, ideally first round checks, and our biggest, we've been around now about 5 years. My background is I was an engineer in the East Coast and in New York. And then I went to business school, had a short stint at a company, and then went into venture about 8 or 9 years ago, worked at firms like Samsung Ventures, True Ventures, and spun out about 5 years ago to start Array Ventures. Yeah, I'll stop right there, and happy to answer every question you all have.
Cool. Paul, would you like to give us a little bit of your background?
Yeah, absolutely. Thanks for having me as well, Pankaj. My name is Paul Sethi, co-founder and managing partner at 2048 Ventures. Going back to the early days, I started out as a tech investor in the hedge fund world, so public equities, and then started investing at the seed and pre-seed stage about 12, 13 years ago, just initially as an angel. I've been fortunate to be earliest investor in a handful of now billion-dollar companies, including Transfix, Flexport, and Notel. Spent the 7 years just prior to 2048 Ventures co-running and building a SaaS sales intelligence platform. Ironically, very similar to ZoomInfo, which went public well above $10 billion last week. We sold in 2018 for less than $10 billion. But we were quite successful as well. With 2048 Ventures, we're just over a $25 million fund. This is our fund one, just launched in Q1 of 2019. We're focused on tech differentiated companies, but otherwise sector agnostic, both enterprise and consumer at the seed stage and pre-seed, writing $300,000 to $500,000 checks. We're geo agnostic, primarily North America. In 2019, we invested in 10 cities. We have a strong focus on particular geos, including New York, where we're based, in Boston, Austin, Atlanta, Toronto, Waterloo, but again, geo-agnostic, and we're making about 12 to 15 investments per year.
Cool. Paul, since you were talking about the types of investments you're doing, could you tell me, a lot of people have been asking questions about, what is pre-seed, what is seed, what is post-seed, where do I fit in? Just to level set, could you share some of your thoughts on what the definitions are, kind of what they mean today, right? And these are moving targets, we get it, but as of today, where would you?
Yeah, I think the definitions, even just if you're looking at seed, I think those definitions, the lines are blurred, East Coast, West Coast, and then even seed, pre-seed. But when we think about seed, we're thinking about companies from our perspective at 2048 Ventures, companies that are doing anywhere from $250,000 up to maybe the very high end, 2 million of ARR. And even for that, it's probably geos that other investors are not looking at. The round sizes can be anywhere from, at the pre-seed stage, $500,000, maybe even slightly less. At the, some of these seed rounds have gotten to be silly, where they're, $4 or $5+ million rounds. But for us, we think about the sweet spot seed round being a $2 to $3 million round. At least that's one that we'll participate in. And part of the reason why we feel like there are lines blurring is because we see a lot of later stage firms that are coming upstream to invest at the seed stage, and they might be buying call options, where I feel like, if you're investing or taking an investment from Array Ventures or 2048 Ventures, this is the core of what we do. And each investment is very meaningful to us versus a lot of these others that are buying those options.
Right. Yeah. I think the $4 or $5 million seeds are, even on the East Coast, they're a little more frequent than I thought they would be, especially right now. One of my companies just closed a 4 million seed on Friday, actually. So,
Congratulations.
Thank you, Shruti. Any thoughts on pre-seed and seed and what the definitions are, and are your definitions different being on the West Coast?
Good question. Actually, no. Definitions are so all over the place and depends on what firm is using them that I actually try not to avoid. I actually avoid using those words, which is why I said I invest in first round, and I don't want, it's like of inception formation of a company. Actually, very similar to Paul. Only like investing in rounds that are about 2-3 million, max 2-3 is on the higher end, and usually it's in a stage for us where the founders are just beginning to think about starting a company, leaving their jobs, anywhere from that to we've done that work and we have a few friends who might be our customers. So it's still in that realm of we haven't quite figured out product market fit or scale, but we're raising money from angels, friends and family, and few firms like ours, like Paul's and mine, or something like that, that can fill up the round pretty well to really help them get to the next stage. I feel our success is when the founder gets to either 1 million ARR or next round of investment through a good, reputable investor for large Series Seed or a Series A.
Okay. So is it fair to say that both of you like to be the first institutional check in a company?
Yeah, I would say that's where our sweet spot is, exactly. And the round sizes kind of vary depending on the founder pedigree and other things that come along with it.
So
I'll say we like to be first institution, but we're happy to be co-investor. We don't need to be a lead or co-lead. We're happy to co-invest. At the pre-seed stage, we're almost invariably leading that round.
Shruti, do you guys lead also, or are you?
Exactly. So we are in a similar spot. So last 2 deals for us this year, one is lead, one is co-lead, but we've also followed as well when it's right.
Okay, gotcha. And right now, based on kind of everything that's been going on for the last 3 months, are you guys seeing numbers changing in terms of round sizes, or is seed not 4 million? Is it coming down more into the 2 or 3 million range, Paul? Like, are you seeing any of those things change?
We expected to see a lot more change. I think very quickly there was the knee-jerk reaction, and I think certainly some of the Seed Plus and Series A's we saw snap to pretty quickly, where the valuations plummeted just because there was that reaction, that allergic reaction to what was happening in the broader markets. But I think broadly speaking, we haven't seen corrections like we expected. I think the demand for the best founders is consistently strong. There is supply and demand. There's a lot of dry powder out there. Like I said earlier, there are the larger funds, the later stage funds that are coming upstream to try to play at the seed and pre-seed stage. And so that is impacting what we do. We haven't seen valuations nor round sizes really fall off significantly, aside from some bridge rounds happening, which are not necessarily core to what we invest in. But we've seen some of those go off at smaller round sizes than may have been traditional pre-COVID.
So are you seeing, sorry, go ahead, Shruti.
Same. The thing is, the companies that are raising are still having competitive rounds. And by the nature of that, they're ending up raising more. Like if they went out to raise 2, they're raising 3, 4. And because of the dynamics of the round, 20%, whatever ownership, the post ends up looking, in the teens, high to mid teens. And for that reason, nothing has changed. And that's, when weird, yeah.
Do you think that's weird? Do you think that's okay? Do you think that's
weird? Because we were expecting it to change as well because of the market dynamics, but the private markets have not really seen the change. Maybe the disparity has been that the founders who know how to fundraise have been able to get to those kinds of dynamics, and the ones that don't know how to fundraise might be lagging behind. but there's plenty of founders that are still raising. Like, I'm pretty, packed right now with first, round pitches and things like that for companies. So it's not slowed down in any possible way.
And then I think to Shruti's point, I think in terms of what the entrepreneurs are being encouraged and coached to do is to take more capital, because whereas we might have wanted to see 18 months of runway and that would have been sufficient to invest at the seed stage, now we'd like to see 24, in some cases up to 36 months of runway. And so when they're taking more capital and everybody's encouraging them to take more capital, it tends to lead to those valuations staying either where they were or slightly higher.
Right.
Yeah. So, is that something that you guys are doing with your portfolio companies that are potentially looking to raise money or have been raising money over the last couple of months? Are you advising them to raise more money than 24 months?
We are. So whereas we would have said for pre-seed, we might have even invested with 12 months runway. Now that's certainly 18 months, because we just don't know where the next phase of COVID could hit. And in terms of the metrics they need to meet, whether they're at the pre-seed stage or seed stage, the metrics are the metrics. And in fact, the downstream investors might have a stronger filter and screen to saying, I want to see more, to be able to to justify that valuation that they're going to invest in. And so we want to make sure that they're going to be able to just meet those metrics to get downstream capital, and or for us to be able to support it. And if something doesn't go according to plan, then they should have, instead of 12 months, 18 months at the pre-seed stage, instead of 24 months, maybe longer at the traditional seed stage.
I think it's more just founder-led in that case. But yeah, what we are telling is, we don't know. I mean, the funny thing is the guidance keeps changing by the day in some weird ways too. Like March, when we all were uncertain about where this was going to go, that was certainly what we were telling our founders, that like plan for 3 years or whatever. Like if you can, like 18 to 24 months and plus, if you're if you're able to do that. But now it's almost weirdly like back to normal. And so it's, founders are saying, well, I don't know, I can go back out again in like, a year, or it's founder led, and we kind of still telling them to raise for at least 18 plus months. But that's not changed, right? Like usually you do tell your founders to raise 18 to 24 months regardless, and then they may go fundraise sooner. So I think it kind of is a good security to just do that anyway.
Yeah. I mean, I was having a chat with one of my companies last week, and that was pretty much what I was telling him was just, go, if you're going to raise right now, try to get 24 plus months of runway. If the market continues to look normal, or whatever normal really means these days, that just means you have more money to spend in that 24 months. If things don't look like they're going to change, you're good. But if they do change, and if things start moving south, you know what, you can extend that runway a little bit and wait it out a little bit. So, I think a lot of this is play it by ear and see where things go over the next couple of months, which is, I think, a lot of founders that, might have raised 12 to 18 months of runway 3 or 4 months ago, right before all of this started. I think some of those founders are in an interesting position right now, where they might have to go back out in let's say 6 to 12 months and start looking to raise. So, the follow-up question I have for you guys is, those companies, and some of these might be portfolio companies of yours or other companies that you've looked at, what's some of the advice that you could give to some of those founders that are going to have to go out and raise in the next 6 to 12 months? Like, should they be conserving cash right now? Should they be spending more to kind of up their metrics quicker? What would you say?
It's company dependent. I don't think there is one answer that fits for everyone. They should definitely be scrappier if they were not already doing that. They should, reevaluate their physical, office spend, which again, they were at my stage. Companies are very careful to begin with, depending on the company and the dynamics and where the team is. I think they're wise enough to make that kind of decisions on their own. But I think the thing I do tell them is to go out and raise right now. Like I've been saying that from March, and I don't think that guidance has changed. Like if you were going to go fundraise and you were thinking of fundraising this year, do it. Don't stop, because again, I don't think the markets have changed, and I also don't think that waiting helps. We don't know what Q3 and Q4 will look like. Arguably, could be worse, or maybe best. We have no idea. But just go while the markets are still open to get that cash in your bank right now.
That's a little tougher for companies that might have raised, let's say, at the beginning of the year, right? If they close money, let's say in January or Q4 of last year, they're not necessarily ready to raise money right now, right? But they might be ready to raise money early next year.
Well, actually, it depends. I think one of my companies did that, and they're going to go raise out right now again. It depends on the company. I mean, as I said, that used to happen even before. If an investor wanted to invest in the round and couldn't get in, they'll prompt the round. I think it's all dependent on how the founders are able to take advantage of that, investor dynamic to make anything happen. But it's, again, all founder-led generally. I don't think I can tell a founder who's scared or unable to bring conviction in themselves, or sell a good story to go out fundraise if they're not ready, right? So it's not led by me. I'm just giving them market, insights, validation, or if they're on the edge, which a lot of the founders were, like, oh my God, everyone's telling me to shut down, and I'm gonna go, not do anything and just focus on work. It's a normal founder tendency to do that. All of us tend to do that, right? Like retreat to what we know we can control. I think that's when I give them the push to say, no, just go and test the waters. Test the waters with a few friends, a few people you've been in touch with. But yeah, I think to your point, yeah, if they've raised in Q4, just start getting ready. Like start working out, data room, deck in order, and just wait for the right opportunity to go out. Obviously, again, this is generally founder-led, but I tell founders to not go out fundraise for a while. Create, whole a process around it, not just randomly take meetings. So again, we have guidance around it, but every company and founder is different in what they're comfortable doing.
And depending on what kind of business you're operating and what you've actually been able to accomplish, even in this period, investors are always happy to talk. Yeah. They may not have the right intentions to close, depending on the fund. They may not be ready to close an investment. I think, both, it sounds like Array and ourselves certainly are ready to close on investments during this period of time and have been throughout. Some haven't. Some have been pencils down for a little bit. And I've heard that expression a few times, but that doesn't mean they don't want to meet with founders and take the time to nurture those relationships during this period. But to Shruti's point, we're actually about to close on an investment in a company that did their pre-seed round in Q4. And we're just about to close on an investment in their seed round now, but they were able to hit certain milestones, not necessarily the traditional metrics, but milestones that we needed to see to get more comfortable to pull the trigger on this type of investment. And then conversely, I have another company that we just closed around in Q1, and they're sort of hitting the pause button on the BD side just because they thought they wouldn't be able to advance those conversations, and just diving much deeper on the product side just for this quarter, just for this Q2, and then they're going to be right back at it and going hard on the BD side coming into Q3 and certainly rounding out the rest of the year.
So continuing on with that thread about the deals that you've been closing.
Actually, one more to Paul's point. Yeah. The other thing that is not talked about is expanding the current round. So we are also investing in a company that closed around angel round in January, and they didn't think they wanted the money, but now the founder thought it would be good to take more money. So that was a safe round, and we just converted it to an actual price round.
Yeah.
Or they can just take more money in the same safe or higher cap or something like that too, if it's a good company. So that's another thing you can do.
Yeah.
Because rounds are.
Are you seeing a lot of that, Shruti, where the founders that raised late last year or early this year are now kind of extending those rounds and either keeping the caps the same or extending those caps?
I don't want to say a lot of anything. There's a lot of everything right now. It's all like in our khichdi, if you want to call it.
Yeah.
Since you know. But I would say it's like a mix. It depends. Every company is different, but the thing to know is that you can create and forge your own path into what's best for you and go out for whatever's comfortable with whatever you're comfortable doing as a founder. And I don't think there's one playbook for anything.
Fair. Paul, I wanted to continue that thread about deals that you guys have been seeing and closing during the last couple of months. Could you talk a little bit about that? And Shruti, if you could also share your thoughts on that and what Array's been doing over the last couple of months in terms of closing deals, new deals specifically, because I think a lot of founders that I've been speaking to were asking a lot of questions like, are VCs writing checks right now, new deals? So.
Yeah, so since shelter in place in mid-March, we've closed on 4 investments, 1 fully virtual, end-to-end, start to finish. We're about to close on another one that'll also be fully virtual, where we've never met the founders in person. I'd say, one thing, and then I'll talk about a couple of the deals that we have closed on. One thing I'll say is that with Zoom, I feel like I'm actually able to get, especially when there are multiple founders, I'm able to gauge reactions and target my follow-up and weave that thread of follow-up conversation based upon what I see one founder reacting to another founder saying. And so it's something for founders to certainly be very clear on, that we as investors are looking, and they, very similarly, if we have more than one member of our team on, they should be looking at us and taking cues and signals from members of the investment team here as well.
Are you recording those Zoom calls and like replaying them later on?
No, we certainly no. In fact, we've seen some founders try to record them, and we actually discourage that just because we feel like we could have very frank, forthright conversations without them being recorded. So we would certainly never record any of those calls. In terms of investments, we've made. I'll talk about 2 of the ones that I've led since shelter in place. One's called Converse Now. It's an IIT team based out of Austin, serial founders. In this case, they're focused on conversational AI for QSRs and fast food ordering automation. So in this environment, that's actually gone through the roof. The drive-through, the phone ordering for QSRs and fast food. So it's been the right environment for them. And so they've been, in this short period of time, able to already launch in dozens of Domino's Pizza locations, for instance, and growing fast and showing ROI to these franchise owners very quickly. And then another one, and this is the one I was alluding to earlier, in terms of them being very focused on product for this Q2. It's we haven't announced the investment, but it's an MIT team out of Boston. They're first-time founders in this case. They're focused on disrupting the packaging industry and physical product security as well, by creating embellishments like holograms and lenticulars on that packaging, or on currency, for instance, that would otherwise be incredibly expensive. With their technology, it becomes more mainstream. And so for this Q2, they're spending a lot of time with designers and agencies that are going to be working with the CPG brands on the packaging side and the packaging printers themselves, which is a large industry, and just refining that product during this period of time.
Cool. Shruti, how about you? What kind of deals have you guys been looking at and closing over the last couple of months?
Actually, yeah, I am about to close a deal right now. We've done 2 this year. We'll do about another 7 to 8. One was it started pre-COVID and closed about a month ago. And another one, we met during COVID era and our closing. For us, though, just to be clear, we've always done this. So last year, for example, there were a couple of deals I never met the founder. Closed. One founder was in Seattle, company called ERDB, and then that company also raised a follow-on round from Foundation Capital after our investment 6 months later for whatever 6 million Series Seed or small Series A, whatever you want to call it, round. So for us, we've actually, this is not new. We've done this from the beginning, and I actually, like, it wasn't even Zoom. It was whatever, Google Hangouts or however, or just phone calls. I actually believe in first call with the founder being just a plain phone call. any company I talk to, just because I like to understand the idea and the merit without all the biases first. And then I go on and take a visual meeting if I feel like that's necessary with the team and things like that. But for me, business is as usual in terms of how we invest. Our teams that I'm investing in, this year, one is Bay Area and remote. They're Danish founders that moved here not too long ago, and the other company I'm investing in is like in a rural town near Ann Arbor, Michigan. So it's and again, that I told you last year, we've done deals all over the country as well. So we've always been pretty open to teams all over the world, headquartered mostly in the U.S., but with offices back in, a lot of my companies have offices in India and Israel, especially if they're security enterprise companies. So it's pretty broad in terms of that, and we continue to invest, as I said, in 7 to 10 more companies this year.
Cool. Okay, that's good to hear. A question I have for both of you regarding, it's not about predictions about where things are going to go, but it's more of how has the last 3 months affected your thesis? Are you changing what you're looking at based on things that you've learned over the last 3 months? And is that forcing you to be more optimistic about certain sectors that you may not have been before, and perhaps pessimistic about certain areas that you were more bullish about before?
I'd say on our side, we were and have been very excited about health tech. We haven't pulled the trigger. It's not a majority or a focus area. Again, we're sector agnostic, but it is an area where we feel like there is continued opportunity. We've invested in some moonshots in the space, in the proteomic space, and leveraging gene sequencing as well. That's more my partner's area. And I think even more so now, I think, with telemedicine, telehealth, it may be overplayed, but I think there's tremendous opportunity depending on the models that are forming and those that have experience to actually execute and operate within regulated environments. So I think that's one where we'll continue to take deep dives. Ed tech we've generally found to be tough, although it's another area that's obviously booming. So I'll caution to say that it's an area where we're cautiously optimistic, but certainly guarded in terms of any investment. We'll consider understanding that selling into, whether it be K through 12 or college or beyond, is just a difficult endeavor, but there's certain models that we feel like are going to really work. In terms of just shifting thinking because of this, we're very careful not to get overly excited about models that we feel like will have benefited just in this environment and may continue to for the next 6 months, but may not have that long-standing resilience. And at the same time, because of this type of shock to the system, we want to be pretty sure that anything we invest in can weather the storm because of the stage at which we're investing. P1, priority one, is survival for the companies. If they can't survive, they can't have that ability to grow into something extraordinary. And so for us, we take that seriously and need to when we think about the investment. And that's a slightly different lens, only because we know that this could, rear its ugly head again, unfortunately, later this year or next year. So that's probably been something that we hadn't been really thinking too much about it, but now very much are top of mind.
For us, I think enterprise is generally pretty broad in this space. Like, it's selling to businesses, but what has kind of changed a little bit is areas of enterprise. For example, security is pretty big right now because we're all working from home, and companies are scrambling to figure out how to give access to employees remotely and things, like it's just a different world that they hadn't thought about. And so security is a big deal now. So our last investment is actually in the security space that we haven't announced yet or closed yet. So it's so it depends on what areas of enterprise. But I was looking at a competitor to like a Trip Actions or something like that. And now I don't know how to think about that category. I know it will pick up for sure, but I just don't know. And I don't want to fund companies to nowhere. And so if I invest in them and they don't have enough runway or the right plan and things like that, then how do I think about those categories? So that's generally what kind of keeps me, like as Paul said, EdTech is in a similar category. You don't want to fund them right now, and then once things go back to normal, whenever they do, we all crave to just be in a classroom without the softwares. So anyway, I think for us, B2B generally means more cloud infrastructure security stuff anyway, and those things are not going anywhere, and we're making investments in those category, and then the rest is as it comes.
Yeah. Since you mentioned cloud and you also mentioned international before, we got a question from Lewis, who's in Chile, and he's just asking, if anyone would be interested in at least talking to him about cloud technology, and can anyone point him in the right direction in terms of seed funding investors that are.
Feel free to reach out to me, Shruti at array.vc. Make sure you include your deck. We can have a follow up with you pretty fast, especially if you have any attraction you can talk about and things like that. But that is an area people are still investing in. So you shouldn't have a hard time talking to anyone in the category, basically, any investor in the category.
Yeah, and then
and I was going to say, same here. We actually closed on an investment called Turbodega. That's a Peru-based company, which is an anomaly for us, but we're actually ironically looking at a health tech company in Argentina right now, going after Latin America as well. And so we're certainly open to it, as evidenced by the first transaction we closed. So you can certainly email me as well at psethi@2048.vc.
Fantastic. There's also Startup Chile locally that could be of help, Lewis. I think there's a lot of accelerators also that are investing internationally. So, whether it's a YC or Techstars, those are always good options to try and reach out to some of those folks as well. I want to ask you guys a little bit about the public markets. I'm sure you guys have been tracking the insanity.
Paul here and let him tell us if he's made a shitload of money right now.
Yeah. How important is the performance of the public markets in terms of sentiment for your firm, and how you're thinking about risk in terms of the capital deployments, right? Is today a better day for you guys to write a check than perhaps a month ago, right? Like, how closely do you pay attention to what the NASDAQ is doing, and does it really matter, right? I know for later stage investors, it matters a lot more because, you're probably looking at the IPO windows a little bit more closely, but for early stage investors, those are way out, right? So how important is the current stock market to you guys?
I think first and foremost, there's a lot of noise. This is an exceptional time where there is more government and federal support than we've ever seen before, including the 2008 and 2001 timeframe. So I'd say that this is a moment in time. It's a very, very sad and unfortunate moment in time where the market reacts the way the market does because of a few things, including government intervention and then obviously the sentiment that the largest investors do believe that this too shall pass. From our perspective at 2048, certainly, and at our stage, at the seed and pre-seed stage, it doesn't affect much in terms of the way we think about investing, because for our most successful investments, it will be a 7 to 10 year journey. And so provided we think they could weather storms like these, again, in the short term and have enough capital to withstand something like this, again, in the short term, we feel like it's as good a time as any to be backing the best of the best founders. And certainly this type of environment, you do find founders that have the grit, the drive, the resilience. You have some of those who thought that the startup world or the founding, being a founder was glamorous, or there was some glitz around it, and rather than go to the Goldmans or McKinseys of the world, they'd come startup company. I think you lose a lot of those participants who weren't necessarily genuine about their interest to build something that's mission driven. So I think, again, this is a strong time to be backing founders that truly believe what they're building can really make a difference in, not just the world, but really the sector that they're looking to disrupt.
Cool. Okay.
I think, and I laugh because it's, very easy to say I don't care and it's long trajectory, but we all do care. And I think when the market.
So you bought Hertz.
What?
So you bought Hertz.
Yeah, I bought Hertz right now when it's gone up already. That's exactly what you buy high. I mean, the thing is, it's just very hard as a human or a firm to not react and freak out based on that. And while, yes, we don't want to look at the public markets in making these decisions, but, markets go up, we stay optimistic. Markets go down, everyone freaks out. Even if it's not you, your LPs kind of call on you and figure out where their money is and what's happening with their investments and, all of that, just generally check-ins and things like that. So I think I would say I don't want to think and make decisions based on that, and I try my best, but it's hard to avoid.
And I'd say one thing to Shruti's point, when you're talking to, when founders are talking to funds, and it's a question that they were asking previously, but it may be more important now, they do want to get an understanding of where that fund is in its life cycle. So, our current, this is fund one for us. We're very young as a firm, but being just 12 months in means we have another 24 months of our active first check writing capability, which means we're not just saying that we're actively writing checks. We certainly are. And there are many funds out there that are also doing the same. And then there are a handful that may not be, and may be pretty guarded with the rest of the capital they have, because they know it may not be as easy to go out and raise their next fund in this immediate environment. Long term, it probably should not be an issue, but in the short term environment, it may be challenging.
Yeah. So, Paul, continuing that thread for a second, what are your thoughts on fundraising for VCs over the next 6 to 12 months? Do you see LPs becoming a little bit more conservative? Do you think that it is going to get harder for funds that are going out, towards the end of the year to raise money? What are your thoughts on that?
I'm going to defer to Shruti on this, only because our LP base is very not very non-traditional, but non-traditional in that our LP base is made up primarily of very successful founders. We have about 50 of them, and then we have about 20 VCs, strong ones. But we have very few family offices, and we don't have traditional fund to funds or endowments or pension funds that are LPs in our funds. So I don't have a lot of color, other than just anecdotally hearing that they are, as I was just using that phrase earlier, pencils down. They're a little bit more pencils down, aside from the funds that they've already backed, because those are funds that they make multi-fund commitments to.
Right. Okay.
I mean, I don't know. Everything is up in the air right now. For everything's fair game, basically. It was tighter before. I'm not fundraising. Same with like Paul. We closed our second fund last year. We're 25% deployed, plenty of cash, to make investments for the next couple of years. But we continuously talk to LPs still. And I think there's, again, two perspectives. People were freaking out earlier, and now people seem to think like the window's opened up again. IPOs are back, so must be all great. But global pandemic, whatever, can we can figure that out later. I think, but what I have heard is 2021 is going to be even harder to fundraise in 2020. People have written off this year mostly, and that's cool. But that means 2021, a lot of people are going to go out and fundraise again, and then a lot of funds won't have traction and data, and because of where things have been with companies, and their metrics won't be good enough for them to raise follow-on rounds. So I think a lot of shakeout of funds will happen, but people have been saying that forever. So I don't actually know what's going to really happen. But anytime there's a window of opportunity, fundraising activities end up, going high peak there, and then kind of they are just like the public markets, even private markets are so volatile. So the answer could change every day.
So what's the leading indicator and what's the lagging indicator, do you think, for LPs, measuring LPs mood of the day? Is it the public market that is the leading indicator and venture that's the lagging indicator?
I mean, when do you ever know LP's indicator? Sorry to say that, but having fundraised now enough that I don't know. It's like I woke up on the right side of the bed today.
All right. Coming back to international, what are you guys looking at internationally, in terms of geographies, right? I think there's a lot of interesting things that are happening internationally, especially Latin America, and some stuff in the Middle East as well. What are your thoughts on international, as a fund? Is it as a part of the portfolio, are you actively going out and allocating money internationally, or is it more of an opportunistic approach? Can you tell us a little bit about that?
For us, international approach has always been more of a U.S. entity, and international teams, co-founders, and others are based in other countries that are okay for us. Market-wise, we like global markets or U.S. markets. We don't invest in a particular region other than U.S. So I think that doesn't change for us. I'm not going to invest in a Latin or another, like a Middle East or some other deal only. I think primarily because for us the buyers are enterprise, and we like to focus on markets where the enterprises are making big purchases, which tends to be mostly US or maybe Europe. Some of our companies are doing that next. So, but yeah.
We at 2048 Ventures, we're primarily US and Canada, so we're geo-agnostic across really North America, but really primarily US and Canada. And as we look at others similar to Shruti, we'll only invest in US entities, with the exception of Canada, where we'll invest in Canadian entities, and we'll opportunistically, to your question, look at LATAM, opportunistically look at Asia or Europe. We haven't seen anything out of the Middle East that we dug into, but certainly the other three, we have spent some time and pulled the trigger on one outside of the US and Canada so far. We do see that there's, we want to make sure that if we get involved with a company, that we could add some unique value to the founders. And in a lot of the cases, we just can't say that we can't say that we could be more helpful than a local investor would be at our stage. So we're typically, if we do make those exceptions, we'd ideally like to also partner with somebody who is local, that we believe can really help shepherd those founders in a way that maybe we cannot by not being on the ground with them.
Fair enough. Over the course of the funds, I think the portfolio is going to change in terms of companies that have matured a little bit more quickly than you had expected, companies that are perhaps taking a little bit longer to mature. And since both of you guys started roughly a year ago, you're about a year into your funds, you have another, let's say, 2 years left on writing first checks. In terms of follow-ons, how are you guys approaching follow-ons for those companies that you've invested in already? And are you looking for other folks to lead? If the market over the next 6 to 12 months starts souring a little bit, are you perhaps going to look at leading rounds in existing portfolio companies. Can you share a little bit of your thoughts on that?
For us, follow-on strategy is been consistent. We don't lead follow-on deals, and we let the market price that. And we save a small portion of our fund for follow-on capital, but we don't like signaling too many things from that perspective. So we're mostly a first, think of us as like a first round company,
Okay.
investor, and follow-ons are discretionary based on reserves and other strategy that we think makes sense. But we're not out there leading follow-on rounds with companies.
Okay.
And we're very similar. In fact, maybe even a little bit more skewed toward first checks. Our strategy isn't really in this fund one at least, to reserve capital for follow-ons. Once in a while we'll participate, but it's not going to be certainly we don't want to be the ones sending signal. We're certainly not the ones that are leading, and we're not committing to following on. What we've done is align ourselves, including with the LPs in our fund, with strong downstream investors that we believe are going to be great partners to the 2048 portfolio. And then we've actually been very intentional about continuing to build out the network, as many other funds do, with investors at the traditional seed if we've done pre-seed, at the Series A if we've done the seed, and beyond, to make sure that we're introducing them at the right time to the right partner at the right firm, so that they get those relationships in place when we feel like they're ready to start having those conversations.
Gotcha. All right, well, we got about 10 minutes left. If we've got any questions from the audience, please throw them in the chat window below. In the meantime, I'd like to ask both of you for a little bit of a prediction of where things are on a macro level over the next 6 to 12 months. Where do you think things are going to go with pre-seed and seed? Do you think we're going to see smaller check sizes? Do you think we're going to get fewer deals over the next 6 to 12 months? And not necessarily what each of your funds are going to be doing. I know both of you are going to be writing a lot of checks, but broadly, on a macro level, what are your thoughts on where things are going? Do you think this, let's say the loosening of everyone's belts over the last couple of weeks is here to stay and it's back to normal? Or, are we really just kind of setting ourselves up for a more difficult second half of the year? So who'd like to start?
Go ahead.
I can, yeah. I'd like to say, and I think this is, pre-COVID, I already thought we were in a pretty heated, frothy environment. So I'd like to say that valuations will come off, that founders will become a little bit more realistic. But like we were saying at the top of the hour, that there's a lot of supply and demand. So, for the strongest founders, there's always going to be demand. So that's likely not going to be the case. What I like for founders who are otherwise going to think about taking, $3 to $8 million in a more traditional seed or seed plus or Series A round, to take $1.5 to $2 million, because they, in this environment, can be more scrappy. They could be capital efficient. They could hire and retain talent more effectively than maybe pre-COVID, and find talent that will be displaced from other organizations in this environment. Certainly, and this may sound self-serving, but yeah, I'd love to see some of those companies that wanted to go out and raise massive rounds right out of the gate because of their pedigree, because of their experience, be a little bit more realistic, and we feel like we could be great partners to them to help shepherd them to that next level, so that they could raise a significantly larger A round after they've hit certain milestones and proven certain things out. And I don't think that is unrealistic in terms of that kind of dynamic playing out. But if the markets continue to race the way they are, we're probably going to see less of top talent being displaced from certainly the large public companies, the large public tech companies at that. And then none of what I'm describing may play out, and we may just be left back in that heated, frothy environment that we were, earlier this year.
Okay.
I have a lot of thoughts. They may not come out coherent, so bear
That's
with
okay.
me. But first thought, I think I was always opposed to like a founder who hadn't baked an idea really all the way to go raise money, but they could. And the funny thing is, they still can, but with the caveat, like anyone who has access to capital wins basically. And it could just be like in the previous world it was rich uncle to now a rich friend or whatever, right? Like with someone's recent exit. So can invest and can get you going. And that's what it takes. You can raise a 250K, 500K, million, $2 million round based on nothing. And it's all in the fundraiser, the founders and their ability to fundraise. So it's kind of like for us, oftentimes for us, meaning Paul and I, the pre-seed stage investors, that often we're competing with that dynamics of, angel investor who's in love with the friend and wants to just write a check blindly with high valuation to a big fund. Similar dynamics, as Paul said, same thing, right? Like a bigger fund is always trying to buy an optionality into that round, and also price insensitive sometimes. And so we're squeezed in some ways, and at our stage, but a founder that is savvy is able to understand that getting checks from folks like us is actually harder because we're actually more thoughtful, because every dollar matters a lot for us in the way we think about deploying it, how we want to allocate our time to these founders and help them get to a proper next set of rounds. So, that is something to be considered. If there are plenty of rounds that are still for repeat founders who know how to fundraise, nothing has changed. But for founders who don't know how to fundraise, things were hard, and they're even harder now. So, yeah.
Okay. We got one question. This is kind of an easy one if either of you want to take it. What's more important, for founders that are saving money on travel and entertainment right now? Should they be investing in product, or should they just be extending their runway? Which is more important?
And I think it's very company specific. It depends where they're going, what metrics they need to hit, what metrics they believe or have been coached that they need. They specifically, that company specifically needs to meet to ultimately get to that next round of funding. So if product is going to be a determining factor for an investor to come in, and the investors who have signaled to them that they'd be considering investing, and strong investors have, then maybe it's that. But if it's fight to live another day so that they could go back to really pound the pavement on the biz dev front, then it's preserve runway for now. And if that means making tough decisions around cuts or headcount, that's a different scenario also.
Think about it this way. What do you need to get the next round of funding? What do you need to make it happen? Like milestones, which is revenue or product or whatever you might need to get. And do you have enough money to get there? If you think you need to raise money in 6 months and you need to get to a certain revenue milestone or whatever your KPIs are you going to get there with whatever you're spending on?
Cool. All right. Paul, Shruti, any parting words?
No. Looking forward to hearing from some of the founders that have joined here today.
Same here.
So, if you guys can share your email addresses one more time, or how folks can contact you.
You can find me on Twitter. I'm at Shruti, ATSHRUTI. On my email is shruti@array.vc. If you are reaching out to me, just be kind enough to include your blurb and deck. It's very easy for us to follow up with you and tell you what's a fit, not fit. And I also try to give you my perspective if possible. But this is not the world where decks are so, precious. So please don't keep them to yourself.
I'm at psethi at 2048.vc and on Twitter at Paul Sethi.
Cool. Paul, Shruti, thank you so much. It was a great discussion, and I'm sure a lot of people will have learned a lot from listening to you guys. Hopefully we'll do this again in maybe 6 months and kind of see where things end up.
Thanks,
Thanks, guys. Thanks for having me.
All right. Thank you very much. Thanks. Take care.
Bye.
Bye-bye.
All right. Did he just leave us here or what?
I guess.
Or wait, is this still live? This is still live.
Okay.